Hey, what's going on, everybody? This is Chihiro Kurokawa here with.
Well, Pedro De Leon got a little lag
Mhm.
there, right there, but yeah. So happy Thursday. Before we get to bring in the guests, I want to say thank you for those that reached out last week because we didn't have a live show, but thank you. So we're back again. So thanks for being a fan. So we're two guys that we're looking to learn more about alternative investments and diversify our portfolio. So talking about diversify portfolio, we have Ron Glasgow, who is a 20 years experience in finance and is a former U.S. Marine who turned into investment strategist. And I like this tactical and technically proficient approach to wealth management. He earned a CFP designation and has a master's in financial and tax planning. Ron, hey, it's great to have you here. Tell us a little bit about yourself, more about what you do and how you help your clients.
Yeah, sure. So number one, thank you for having me. I really appreciate it. I'll go back a little further than normal simply because I know you're a veteran too. So thanks for everything you did in the Army.
Yeah.
But I grew up in a small Midwest town, Granite City, Illinois. It's got a steel mill in it. It's kind of one of the things is kind of want to get out of there if you can a little bit, even if you come back. You just want to see the world. I was always pretty decent at school. I figured college wouldn't be a problem, but I listed at 6'1", 135 pounds. So think about that. It's pretty skinny. And I didn't know if I could do the Marines. I mean, that was a big question mark. I wasn't a great athlete or anything, and can you do it? So I just listened to Marine Corps Infantry. And boot camp was a little rough, got better at the end. SOI was grueling, but you made it. And then I think when I got out a few years later, I was like 6'3", 195. So it's a lot of weight gain in there. The Marine Corps is the thing I'm by far the most proud of in my life, but it's not the highlight either. You don't want the highlight to be when you're 20 years old. That would be great. So when I was in, I got in right after Gulf War. So when I was getting out, that was over pretty quick. The Army did a great job with the Marines, and it seemed like we're gonna have this longevity of peace. So I got out, went to college back in Illinois. All state schools are free for veterans in Illinois, which is a great thing. So I majored in international business and finance. Frankly, I had majored in international business. I could do 2 study abroad programs, and then finance is really where I wanted my career to go. And an interesting thing, you don't really know what jobs are out there when you go to college, right? So I got lucky enough to get an internship at the old A.G. Edwards, phenomenal place. I looked around and saw that, hey, I think I'd like to be an advisor versus being a bond trader where you just sit on the desk with 10 hours a day. It was pretty grueling. So applied with AG and Edward Jones. Edward Jones came back first, and they were expanding. So I came right back to San Diego, where I was in the Marines, and started building my practice. I was 25. I didn't know anything except when I was trained. They taught us to knock on doors. So I literally would go and knock on doors. I really did that. And
Wow.
I would really go back to Marine Corps boot camp than, not that I could make it at this age, but I'd rather go back to that than knocking on doors again, to be honest with you. It was that bad. I knocked on so many doors, I carry a golf ball so I could, tap it. But because your knuckles would get sore. But after that's how you build a book when you didn't know anything, and you kind of done one of the hardest things there is. So you move up, and then, like you said, it's the Marine Corps drilled this to me: be technically and tactically proficient. So tactically is what you're sort of learning on the OJT. The technical side is when I got my CFP and then ended up with a master's, and that was just simply so I could help clients better. And the number one thing that stuck out through all of that was diversification and non-correlation. The problem is those things sell about as well as tofu at a steakhouse, right? So everybody sells the sizzle, which is going to be the yield or, the potential return. It's not the best way to do it, in my opinion. You really want to have that well-balanced portfolio because it only takes one terrible market to wipe out, your entire plan. Whereas if you miss out on a few upside points, you're still going to be okay. Anyway, after a few years at Jones, ended up going independent. And then unfortunately, my dad got really sick. He got lymphoma and lung cancer at the same time. So I sold my practice, moved back to St. Louis, where I'm from. Frankly, I just needed a job. And this is how I kind of stumbled in the side door on private equity real estate. Phenomenal company called WP Carey hired me. They're no longer in the space, although they're a thriving company in their own right. But I sold some of the original alts, which were non-traded REITs. So that's really where I cut my teeth in real estate and in the alternative space. And over time, I just kept kind of moving and tried to move up. And so I guess the capstone of my career was I was a managing director for a top 10 DST sponsor at the time. and really built out the bulk of their financial advisor and small RIA channel. So, after doing that for 13 years, on top of 10 years as an advisor, just kind of came to I was just ready to do something else. And I used my work to mean something. Private equity is great, but you're really kind of moving a comma. That's what matters there. It's nice to, I remember when I had clients, you really feel like you're doing something well. So I wanted to do that. And I think there's a huge disconnect. I think financial planning and I think investment management has been watered down to a lot of 60-40 or model portfolios. And look, I mean, you have 7 stocks that account for over a third of the stock market's value. There's no way that you're going to get pure diversification if you're only in the publicly traded markets. You got to have some means, but if you do, then you can look at private investments or just simply some other alternatives. And again, it's all about getting that non-correlation and that diversification. And sometimes they yield a little bit more too. So it's not something you trade a portfolio for. It's something you make an addition to. And, those small 10, 20% additions or replacement to make all the difference in the world in a down market in your overall portfolio plan.
So now that you're focused on alternative investments, what's some of the, I guess, asset classes you've seen that people are more leaning towards to? Or
yeah, I would say the number one by far, the alt space, is real estate. So, and the real estate can be packaged a million different ways. So you could have a regular private placement, you could have a limited partnership, you could have a non-traded REIT, you could have a Delaware statutory trust. I love those because of the tax benefit there. They're a little transactional. Somebody's either selling a commercial property or an investment property or they're not. But I mean, they're just phenomenal investments, especially compared to the other real estate ones, because the sponsor can't do any funny business. They can't sell the property and say, hey, we were going to give the money back, but we decided to go ahead and keep it and buy something else. I promise it's going to be good. We've kind of seen those horror stories. With a DST, it's very defined, something that you know what you're getting in, you know when you're going to get out for the most part. As long as the sponsor does their job, it's great. That said, there's other great real estate investments too. You just have to be very particular on doing your due diligence. Something that's come on after real estate is credit. So a lot of credit funds are out there. Private credit is coming on strong. You're seeing more and more every day. And those have multiple structures as well. That's where I sort of specialize. We also have oil and gas and pure private equity. I bring in, the companies for that because I'm not a pure expert. So it takes a team sometimes, and not afraid to admit that.
Okay. Let's take it back to DST. Can you explain, elaborate for the audience, what is DST, how it benefits them, and how it works?
Absolutely. So a DST is a Delaware statutory trust. Okay, so the names always get confusing in this. LP, statutory trust, REIT. Just think of those structures as boxes, right? They're boxes that hold something. So a Delaware statutory trust, what it holds is a real piece of real estate, a real asset, or it holds multiple pieces. But what makes a Delaware statutory trust great is it's 1031 eligible. So say you bought a building for 500,000 10 years ago. Now you're selling it for $1 million. Okay, you're going to have capital gains on 500,000, plus you've depreciated it if your accountant was any good. So now you got depreciation recapture on top of that. So this gain you have on paper, a lot gets eliminated through the tax. So what you can do is you can 1031 it. Now, nobody really has these stats except the IRS, and they don't release them. But I would guess 80-ish, 90% of 1031s are real asset to real asset. Although Delaware statutory trusts are coming on stronger. And again, think of it just like a mutual fund, and I'm oversimplifying it by far, with a piece of real estate in it. So you can do all your due diligence on that real estate in addition to what I've done. Most sponsors will open up the appraisals, everything to you if you want. And then you roll in there. And the real benefit is if you're tired of taxes, tenants, and toilets, you get out of that. So now you don't have any day-to-day management. And I know, I've met a lot of people that have professional managers, and sometimes you end up managing the managers, right? So you're totally out. You don't have to worry about anything except a check in the mail. Also, It helps you sort of scale up your real estate. Even if you're a wealthy person and you have 3 or 4 million to invest in a property, it's not near the diversification or quality asset you can get if you pull your money and we go out and buy, a $50 million asset. So it just opens up the world to you. They're useful for some people. Some people love to manage it themselves. It's up to them.
So is it, at least structurally speaking, is it similar to being an LP in a syndicated real estate deal?
A little bit, yeah. So what you technically have is you're technically an owner of fractional shares of that trust. So, but it's pretty similar. Like an LP doesn't really have day-to-day management. Neither do the DSTs. And you find that the DSTs are sort of the next iteration. This all started with TICs way back in the day, Tennyson Common. Now, these were kind of nightmare stories because you had to get everybody to agree on when to sell the property or whether to hold it. I mean, my HOA board couldn't agree on a landscaper. There's 3 of us. So I don't know how you agree on something big for real estate like that. And the evolution is DSTs, where you turn over that responsibility to the sponsor. So that's where you really, really want to vet your sponsor as thoroughly as possible. I mean, a great sponsor could have a bad deal. That's just the way it goes. And you could have an untested or a bad sponsor that could have a great deal. You still have to kind of sidestep that one because you want to make sure that person's there for the whole ride, the 5, 7, 8 years that you're going to be in it. And if something goes wrong, you don't want anybody, ducking and covering versus answering the phones.
Wow, interesting. And so then in regards of the with tax mitigation, or this is where folks actually really save the taxes, and then how can they tap into? Well, tell us more about the tax benefits on that.
Yeah. Sure. So going back, so whatever your gain is, you got capital gains plus depreciation recapture. Okay. So what you can do, the crass term that we use is swap to drop. So when you do a 1031, that defers all those taxes. So say you go into a DST, it's a 5-year hold. Go to that DST, we're going to pay you, say, 5.5%, hopefully 6% soon, with interest rates normalizing. Pay you that on an annual basis. Checks come monthly or quarterly, depending on the sponsor. You just sit back and collect those. On the back end, hopefully we get you a little bit of gain. And those are the DSTs I really like, the ones that are very safe, the ones that have mailbox income, as we call it. Right. Just checked in the mail every month, get a little bit on the back end. Now, that's not for everybody. There are those that are value add or significant value adds will have higher IRRs. But as you guys know, the more return, the more risk. So you just have to make sure that you're comfortable with that and it gets disclosed. So let's say you get to the end of that 5-year point, right? Now we're going to give you your money back. And now it's up to you. Do you want to do another DST? Do you want to go back into brick and mortar real estate? You're welcome to. Or do you want to just pay the taxes at that point? Most people continue to swap, and the DSTs, once you're in on, most people continue until, like I said, swap to drop until they pass away. Then your kids get a step up in basis. No taxes should be due at all. And then they have a clean slate to go spend the money however they wish.
Absolutely. Well, thanks for sharing that, because that's something that I've been asking in the past before. I didn't know this maybe 3 years ago. So thanks for elaborating that. Now let's kind of shift the conversation to private credit, because I know this is something that is up and coming. Chihiro just shared a article today about JP Morgan and mentioned about private credit as far as that alts. So yeah, share with that. What do you know about that and how it works?
Yeah, so there's several different types. So a lot of it comes back. So you have, with the real estate side, you have mezzanine debt or B loans. So I've worked for a company that had those. And just as the name implies, you're that sort of second layer of financing. So somebody goes to the bank says, hey, we'll give you 50%. That's not enough for you to get the deal. Now you go to a B loan lender or a mezzanine lender. They're going to give you, say, another 20, maybe even 30%. So you only got to put 80 or 20 or 30% of your own money into the deal.
Right.
It's a nice spot to be in because the yields are much higher. However, you're not in a first lien position either. So the bank's always in that first lien position. So there's always risk. So again, if you're going to do that, you're going to get that yield, and they're very lucrative investments. But you got to make sure you're doing your underwriting, your due diligence on that real estate.
So when you see private credit deals on your end, are they always or almost always in second lien position?
No. So then it goes kind of all over the place. After that, you see how some guys just make first lien loans. A little tough. I mean, the yields aren't great. But then you kind of get the exotic stuff, like a collateralized loan obligation. Do you all know how those work? Or
no, please let our listeners know what a CLO is.
Yeah, it's a little hard to do without drawing a graph, but a collateralized loan obligation really comes down to senior secured loans. So senior secured loans are a great spot to be in because they supersede everybody else in the capital stack, as we call it. Or they supersede everyone else in their right to get their money back. So the classic example is GM. I mean, the GM that exists today is not the one that existed when we were kids, right? It went bankrupt, totally wiped out. So bondholders got, 40 cents on the dollar, whatever it was. Stockholders were wiped out. The guys that had the senior secured loans were made whole, 100%. So if you had those, you did really well. Now, because you're first lien, it doesn't pay great. So how you sort of trump that up to make it worth your while, you can put in what's called a collateralized loan obligation. So you have a pool of these loans on one side that are paying out interest. On the other side is broken down into tranches. So AAA, AA, single A, triple B, down to the equity tranche. So the equity tranche is where you can make the most money. Obviously, it's also where the most risk is. So as these loans pay out their distributions, you funnel it down through each one of those tranches. The way the math works out, when it works right, you should expect somewhere around 10% safely. It should be your return as an equity investor in a CLO equity tranche. So again, it's a little easier if you draw a graph, but that's just another way that you could do it. And it's just taking what we call loanership investments. You're not, in this case, you are owning the equity tranche, but it's still backed by somebody loaning money to someone else.
Does that mean so you're taking the yields from the loans and then buying public stock with it?
No, you're taking the yields from the loans, and then you're living on the spread, right? So when you have the loans on one side paying X. When you get to the other side, you have the tranches. The lion's share of the tranches are AAA, so that's going to be the biggest slice by far. Because it's AAA, it doesn't take that much money. So you've got a leftover from what you earned on the senior secured loan side. So that trickles down. AA gets a little more, single A gets a little more, triple B gets a little more. But those are much smaller tranches than the AAA. So then you get to the equity position. Now, even if that loan was only paying, say, 5-6% or something, you could, because of the way the math works, by having such a huge number of that AAA spot, your equity position, based off that spread, should give you a nice positive return.
Got it.
Definitely. We're definitely going to need a PowerPoint presentation. You know how the military does it with no, but this is great stuff. No, definitely. Now, here's my question to you. What is the typical asset class or real estate asset class that is being lent to? Is it commercial, but what type of commercial?
Yeah, so I would say it's grown a lot over the years. So your stalwart is multifamily. That's the king. It always will be. It's a little hard to lose money on multifamily if you have real estate acumen. I mean, people have, but you have a housing crisis in this country. The price of houses. I mean, what they've done in Dallas alone in the last 5 years, 6 years, they're skyrocketing. So people need a place to live. So multifamily's a nice, clean spot. Within multifamily, you could have Class A, where it's all brand new development. There's a really interesting deal right here in Dallas where they're going into East Dallas. They've been there for years, and they're taking Class C and turning it into Class B. Now, it doesn't sound very sexy, oh, what's Class C, turning to Class B. I've toured these properties, I've toured the neighborhood. If you're going to live in that neighborhood, you're probably there for a long time. And this is the best place to live in that neighborhood. So, it doesn't cost a whole lot to go from C to B. So very, very interesting multiple there. That's a little outside the norm. Outside of multifamily, the other big one is net lease or triple net lease. Sometimes it's double net lease because triple net gets pretty expensive and hard to find. And this can be run the gamut. So, there's some companies in the old non-traded REIT days that really ran with the retail stuff, the Walgreens and stuff like that. And those are nice, easy sales. They normally work out. Everybody knows Walgreens. It's a nice brochure. So net lease does well too. But now you've got everything. I mean, you've got medical office, regular office. Retail is actually coming back, believe it or not. If you have a good anchor, like a grocery store, something like that, the retail spaces around that are doing exceptionally well. Whereas, we kind of always still think of the old strip mall that's dilapidated. Not the case so much, but you do have to be particular, just like any other sector of real estate.
Yeah, definitely. And so without all that being said, what is typically because I know you mentioned about 60-40, right? Being a CFP and talk to your clients. Typically, how do you structure the percentage or the pie?
Yeah, so it's interesting because I guess our friends over at Blackstone just came out and said they think the 60-40 portfolio is dead. It's going to a 50-30-20 portfolio. I think that's a little better. However, I still don't like those pre-canned percentages. You really need to get to know the client and see what can they tolerate. So everybody's going to tell you that alternatives are more risky, and in some regards they are. But really, what the big part of that risk is the liquidity, or in Alt's case, the illiquidity. There's absolutely going to be some illiquidity. Now, that's been massaged out to an extent over the years. In the old days, the non-traded REITs would let you redeem up to 5% per quarter by board approval. So if there was a run on the bank or the REIT wasn't doing that well, everybody wanted their money back. So they stopped it. Now you can pivot to, say, an interval fund. Now, with an interval fund, it's not a private investment. It's still public, but it's still an alt. So it's not traded on, well, sometimes they are traded on exchange, actually. But those have to redeem 5% of all outstanding shares per quarter if there's a demand. So they're trying to soften ways to get more liquidity. But remember, the more liquidity you go, the more correlated you're going to be to the regular market. So you're starting to defeat the
Exactly.
purpose.
Right. Yeah.
It's a big catch-22. And you know, like when you're in a good company like WP Carey, I went through a couple of their liquidation events, and the same people that early on said, I don't want to lock my money up very long, they were the ones saying, look, I don't want my money back. I mean, I'm making 9%. Then just keep it. Just keep doing what you do. So you got to try to find a happy medium with these investments. Liquidity is definitely there. And then, but you really got to know the client. I mean, just take an example in Rockwall, and you know this story well. Take a veteran, for example. Say you got out as a senior officer, you got some good money. You've got your pension. You've got, a lot of these guys worked a second job. You have a second pension. There's a lot of disability. Maybe you're 50, 70% disabled. You can afford to tie up more money because you have 3 income streams that are set for life, right?
Right.
Then you look at a guy like me that, I did one tour, very proud, but I don't have a pension. So I'm got to do this. A guy like me is going to want a little less liquidity in that case, or a little more liquidity, because you never know what's going to happen. So 50, 30, 20, 60, 40, I just hate those tags personally.
Right. Yeah, definitely. Go ahead.
Hey, Ron, what kind of deal sponsors do you partner with?
Yeah, so that's where it gets hairy. So the alts, I read, probably the most valuable part of my day is the hour in the morning I read, or if I can't get to that morning, at least 30 minutes at night. You got to stay current. And man, it's crazy how you really heard about alts 10 years ago, and now every single entity is coming out with platforms or trying to capitalize on it. So it's going to come like a wave. But like I said, the benefit to these, in my opinion, is the non-correlation and diversification. Yeah, that doesn't sell very well. So what you have is a bunch of sponsors that have come out and really tried to juice those yields. So you have return of principal in the first couple of years on some of these, where really they're just paying your distribution because they're still raising money and other people are putting it into the fund. Sometimes that's okay to get it off the ground, but sometimes it goes on too long and it just becomes a bad deal that's overpaying what they can afford. So the bigger the space gets, the better, in my opinion. When the bigger guys move in, they don't play games, where some of the smaller players that maybe come from the true real estate world, they've done some one-off deals. Maybe they've had some local politics that they had to be part of, and it worked to their advantage. It doesn't really work in the SEC world, right? I mean, you're regulated, but real estate guys still try. So you just want to clean it up. So when I came back to look at this side of the desk, I knew alts would be important, but I also know that that you've got to have due diligence. So the broker dealer I partnered with, and we almost always have a partner unless you're an RAA, but even then, a lot of them have partners. But my back office is Great Point Capital, at Great Point, and they have more alts on the platform, and the guy in charge of due diligence there, his name is Keegan De Silva. He knows more about alts than anybody in the country, I would guess. I mean, this guy is a walking encyclopedia of how they all work. So he's your first line of due diligence. After that, you do your own due diligence, and then the client gets to say too. This isn't something where you just kind of sit down and demand they buy it, right? You want to make sure everybody understands and is on board, and you want to make sure they understand what they're buying. Another thing that drives me nuts is I've seen people say, "Hey, here's 5 real estate deals. Tell me which one you want." It's like multifamily and medical office and triple. I mean, they're coming to you for that advice. You can negotiate it, but you don't want the client just to pick blindly. You want to have them educated. If they're not willing to do that, that's fine. Just stick with the publicly traded stuff.
Got it. So in your case, you're picking from a menu provided by your broker dealer?
Correct. Yeah, they still have to go through. I can't sell anything that hasn't gone through an exhaustive due diligence process with my broker dealer. Also, you have third-party reports these days. There's a few companies that do those. Those are really valuable. Then you got to do a training module for everyone you do, just to make sure that you as the advisor know actually what you're selling, which is great. I mean, in my opinion, you have to read the PPMs. It's brutal. They're door stoppers, but you've got to go through them if you're going to recommend the product.
Yeah, definitely. Well, I was going to ask you about what's your due diligence process to help people, because people ask me like, hey, if I want to invest in this, like how to look into, but you definitely answer.
Yeah, and for me personally, where I start, I start with the ownership if it's smaller, or the management, and just are they good people? Like, just are they good people? You can be cocky, you can be a little arrogant. I can deal with all that, but are you a good person that really wants to do good for clients? Or are you just out for the money? And if I feel like you're just out for the money, I don't care how good the deal is. it's off the table for me.
Right. You know, I was listening to this gentleman named Salvatore Bucciami. He's on LinkedIn. And he talks about that a lot of these sponsors or syndicators have great deals, right? But they are very transactional, and that's kind of what kills the deal for whatever they have.
Yeah.
Really. So that's something to keep in mind, you know, of course. So is any way where people can, if they need more information from you, you just turn Ron, your camera, but
Oh,
yeah.
sorry about that. How did that happen? I was gonna say, so let me see if I can get that wrapped around.
No worries. Oh, then we lost him. Yeah. So yeah, but I was gonna ask, but when he gets back on. But anyways, definitely something to keep in mind if you guys been watching this. Here we go. Due diligence is important. All right.
Yeah.
Gotcha,
Typical
Ron.
tech. Sorry about that. Yeah. So if you go to my website, you'll see just sort of some basic stuff on alternatives. It's got some pretty decent information. I'm building out as we go. But probably the biggest benefit right now is all of the DSTs that are available through our platform. You can go in, if you're accredited, you have to attest that you're accredited. You go in and you can look at all the deals on your own. So for DSTs, I put all of them up there because you never know what somebody's going to be interested in, and you're on a time crunch, man. Maybe it's not the perfect deal, but boy, it might be better than paying a bunch of taxes if you're kind of coming up on day 40, 41, 42.
Right. Yeah. Absolutely. Shiro, you have any other questions?
No, this has been great.
No, this is great information. I really thank you for breaking it down for us. I'm sure there's, people have been watching it. They're interested on learning more. So if you're following us, make sure you DM us and we'll send you the website. Ron, thank you so much for chiming in. Give us definitely a background on all these things on alternative investments. And definitely one more thing I want to say for the audience, we do have some swag. So keep in mind, we're going to put it out there. So thank you. Ron, Thank you so much. Appreciate it. Until next time, take care, guys.
Yep. Thanks so much.